Welcome to Chapter 1 homework. I will be going through the homework process with you, how to do it. Let me share my screen so I can describe to you how we're going to go about doing this. Right, so go to your Canvas environment. Click on Access Pearson is one way to do it. If you do it this way, it's going to bring you up to this Open My Lab Mastering. Click on that and then come here, find Chapter 1 homework or whatever homework you're working on. In this case, I'm going over Chapter 1 and I'll go over the other ones as well. When you do that, it'll pop up this flash screen here. There is one, and then you just click get started, and then we'll go into it. Now, I have jumped into this already because my internet's been giving me the spinning wheel of death. I'm hoping that throughout these assignments here, it doesn't do that. But if it does, I'll just try and pause the video or something, the recording of the video, so that this video doesn't get long and you're just sitting there waiting for the spinning wheel of death to go in. All right, so what I want to do with this first one here is, because this is static, it's, in other words, it's going to be the exact same stuff as you are. Let's just answer one or two of these. Basically, we're looking at these individuals and saying, are they considered internal decision makers or external decision makers? A customer is going to be an external just because they're not within the company. Anybody inside the company that has access to insider information is an internal decision maker. So we're going to do that one, and then I'll say a controller would be internal. I know some of you may not know what a controller is. I encourage you, if you don't, to go ahead and to Google it and find out about it. So I don't have the time here to do that. So anyway, those two were correct. Let's go ahead and move on to the next question here. All right, so now it says, consider the following accounting terms and define and match each term to the definition. So I'm going to go ahead and answer a couple of these for you, but not all of them. So here we have IFRS, the International Financial Accounting Regulations. I don't like IFRS. We're not going to go over it. And but I wanted this question. And so don't worry about this answer, because I'm never going to ever ask you about anything related to IFRS. But I wanted all these other things, and that's why I picked this problem. So we needed it, and there was no option without IFRS. Let's talk about partnerships, since we are not doing partnerships in 111. We will in 211, but the students taking 111 will get partnerships in accounting 112. So let's see, partnerships. Asserts that no. Has two or more owners, called partners. Hey, weird. Partners, partnerships. Yep, that one correct. Let's do one more. Let's do creditors. And let's see, type of entity that is designed to limit personal liability. No. U.S. government agencies that oversee. No. Stands for no. Set of global accounting guidelines. No. Person or business lending money. There it is. Okay, so there's a few of them for that one. You guys pick the rest of them. Please remember to go through and answer everything before you use the check my answer work. I will be monitoring how it's being used. If I see it being abused, I will reduce your check your answers for all future assignments to 2. We don't want that, okay? So don't be that person that causes everyone else to suffer. All right, now we're going to get into some of the real assignments here. What we're looking for here is begin by identifying the formula to calculate net income. Net income is going to be our revenues minus expenses. So let's come up here and find out what our revenues are. It says that we reported revenues of $55,000 and our expenses were $45,000. Net income, it gives us other information, but that's not relevant to this question. So we do the math. I'm going to say it's 10,000 because I think if I do that correctly, it's going to be 10,000. All I did was subtract the expenses out of the revenues. Pretty hopefully straightforward. What is the equity during the year is what I think we're looking for here. Oh, did the equity increase or decrease? Now we're going to need to look at our accounting equation. I'm going to pull up an Excel spreadsheet to help us with this one so that we can kind of monitor and see how this rolls. And I will zoom in on this if I can get that corner. Okay. So in this, we have total assets. Now, what's our accounting equation? Is assets equals liabilities plus equity. And just in case, yeah, this is not the expanded equation. Okay. So it says that Peaceful River Spa ended the year with total assets of 24. So this is year ending. So I'm going to put this down here. And just for those of us that like to see numbers as numbers, let's go ahead and at least see it this way. End of the year, we had 24,000 and we had a total debts of 7,000. So what was our equity? Well, if we take our liabilities out of our assets, remaining amount is equity. So at the end of the year, we have $17,000. Says at year end of 2024, which is the beginning of our current year, end of 2024 is the beginning of 2025. And we were dealing with this at the end of the 2025 was this information. So our beginning of the year is that we had assets of 14,000 and we had total liabilities of 7,000. So the question is, what did we have to do? First of all, what was equity? And in this case, it was 7,000. What did we do to have to go from equity to and beginning your equity to ending your equity? Well, whatever we do has to keep us in balance. So what we really have to do is subtract the ending or the beginning out of the ending, and we'll find out exactly how much everything increased or decreased. Liabilities didn't change, and assets and equity both increased by 10,000. So we're going to say it increased by 10,000. Ken, your numbers should be different. Maybe they are. Maybe you got the magic question, and you're also doing the exact same one I don't know. You see my video, my picture. I got my Crystal Life, got my Dr. Pepper, and I got my water. So I am good to go. Given that as a multiple choice question, which one should you choose? The answer, of course, is always Dr. Pepper. Dr. Pepper is always the correct answer. All right, in this one, we are going to analyze these transactions and identify how they impact our accounting equation. With this, I'm not going to do every single one of these. The idea, well, maybe I will. Maybe I will. All right, let's do the first one. Franklin contributed 75,000 to the business by opening a bank account in the name of the company. All right, it says the business gave capital to. The funny part is it says to Franklin. Bad grammar, but it doesn't always say that. The idea is that whenever the owner contributes anything to the company, it's automatically capital. Okay, so we put in. Sorry, we're Franklin, so $75,000 worth of cash, and then our equity or our capital went up by the same amount. Okay, that is that one. And I am a steak. I am well done. Better not be a steak then. I don't want to be well done. But then we bought some land for 44,000. So what happens to cash? We're going to decrease cash by 44,000, and we're going to increase land by the same amount. Notice we're still in balance. Our assets both went down and went up by the same amount. So our balance here now is going to be, let's see, I'm going to do this in my head, 44. So 31,000. And the land is 44,000. There's no liabilities. Our capital is 75,000. Add these together, guess what? We're at 75,000. We're still in balance. Oh, I got to put a 0 for everything else. That's kind of lame. Whatever. See, that's why you watch my video, though, so you know that and you don't make the same mistake. I don't think it's a mistake. I don't think that's even necessary, but okay, fine. So now we purchased medical supplies for 1,900 on account. All right. So our medical supplies are increasing. That's an asset. But our liabilities are going up because now we owe this money to a vendor. So now we're going to fill out the bottom half here. We're going to have 31,000 still in cash, $1,900 worth of supplies, $44,000 of land, $1,900 of a liability, and $75,000 worth of equity. Oh, I forgot those darn zeros again. It's not a normal thing that you do in accounting, but they want you to identify as an academic thing. They want you to be able to say, yes, I acknowledge these accounts exist and that I agree that they are zeroed out. All right. Now what happens on the 15th? Officially open for business. Good job. Nothing happens. Absolutely nothing happens. You just official now. Okay. Put this in here, and I'm actually glad they do because there is a an economic event does not mean there's an accounting transaction that takes place. So keep that in mind. It's not an always thing that we're going to deal with in this class, just because I'm not going to teach you that, when not to do accounting. I'm going to show you what to do when you do need to do accounting. But there'll be a couple things that we want to make sure that you understand that this is an economic event. And by economic, I mean it has something to do with the business, but that it does not impact the accounting aspect of the business. All right, cash or paid cash expense for the following events there here. So that's fine. So what we need to do is I'm going to pull up my calculator and we're going to calculate the total, because whatever this amount is, it's going to be I'm sorry, it's going to be cash. We're going to reduce cash. So I'm adding up the salaries, the office rent, and the utilities. So I got 2,750 as a reduction to cash, 2,750. And then, so what I need to do really quick is I'm looking up here in the explanations, because it says, yeah, I get all that. Enter a decrease in account with a minus or parentheses. Okay, it doesn't really say that. So what we're going to do is I'm going to have to test, because I don't ever remember. In some books do things differently than others, but we're going to see. Now, I say that because we're paying these expenses, we are increasing the expense. We're showing that we use these expenses and that this is how much it went up by. But you notice that we are subtracting these. So it'll be a decrease to overall equity anyway, but we just have to show that it's a subtraction there. So let's check out what we got over here as far as our cash. So we're going to subtract, right? So I have 28,250. I have 1,900 in medical supplies, 44,000 in land, 1,900 in accounts payable, 75,000 in capital. So I have 0 with withdrawals and revenues. And then I also have 1,300 in salaries expense, 1,200 in rent expense, and 250 in utilities expense. It's possible that they're going to want us to show those as a reduction. I hope not, because I don't think that that's really clear. Let's see if they like it. Okay, good. We're good. I'm actually glad they did it this way. I think the Excel assignment, when or if you've already done it, they want you to show doing kind of something like this. They want you to show these in parentheses, but it's because, or as a negative, because I don't think they show these subtractions. So they want to emphasize that. Whatever, there's different flavors. You just have to know, as long as you just don't worry about the presentation or whatever, that you're subtracting expenses out of equity, and that when your expenses increase, it decreases overall equity, you should be fine. Now we have the first transaction on July 31st. It says we earned service revenue for the month of $11,000 receiving cash. Well, we're going to put 11,000 cash and then come over here to service revenue of 11,000. And then we're going to add that to our prior balances. So we have 2, 3, 4, 39,250, 1,900 for everything else stays the same until we get to revenue. That goes up to the same amount. Okay. And then we're going to have one more where we pay on account. So in this case, it looks like we're not going to have any, no withdrawals this period. All right, let me get that calculator out again. 39,250 minus 1050. So we're at 38,200. That's 850. Yes, I used my fingers. Not. You know what? For some reason, it was such a push to not let us use our fingers in elementary school, but I don't care. I did. All right, those are the answers for that for me. Okay, there is that answer. This next one is our income statement. Now, hopefully you're at least familiar with this. Let's look at these account balances here. First of all, we are Choice Fitness. So we're going to put that name of the company at the top. Then we're going to select that this is the income statement and that it's month ended this June 30th, 2025. Always start with the revenues. We're going to go through here and there it is, service revenue 11.2. Okay, 11,200. Remember, if you have taken or if you've watched if we've done the in-class practice problems or the partner work problems, you should hopefully be at least familiar with how to do financial statements, or at least if anything, you watched my video and other things. Okay, our expenses were the rent expense, salaries expense. Wasn't there something else? Rent size, maybe this is just a different problem though. Okay, so we got rent expense for 850, salaries expense 2,500. I don't see another expense, and so you don't always have to fill in this last line. That's okay. Total expenses. So we got 3350, 3,350. I'm sorry, I shouldn't do this in my head. I should just do it and add it up. 2,500 plus 850. Hey, look at that. And then we're going to have the revenues minus expenses. That's going to give us our net income of 7,850. So that's our income statement. If at any point you need to pause, you're kind of just cruising right along, happy as a little clam. If you need to pause this or slow me down again, please feel free to do so. We're going to do. Just reading all of these because I'm interested. On an entity's assets, liabilities, and owner's equity as of a specific date, that's the balance sheet. Assets, liabilities, and owner's equity for a period of time, no such thing. There's no financial statement that does that. Revenues and expenses on a specific date, nope, it's over a period of time. So that's what we're doing here. The other one's the capital, and it's going to be over a period of time, not a specific date. All right, thus ends my delight. Now I can drink my Dr. Pepper without any guilt. Remember, our first financial statement we create is the income statement. That's why I did that. That's why I showed you that one. But you can be assigned, hey, just do the owner's equity statement, or hey, here's the do the balance sheet, just the balance sheet. You'd still have to do the calculations for the other things. So I'm going to show you how to do that on this one. And I'm going to use Excel so that you can kind of visualize it a little better. So let's do this. Gonna go expenses. Okay. All right. So when we're doing the statement of owner's equity, and it's Willow's Gym, it is the statement of owner's equity, and it is as of month ending June 30th, 2025. What is our beginning balance? I'm going to just look at the account balances over here. So if I'm told, here's the statement of owner's equity, and this is all I've been given, I can do it. Beginning balance of the capital account was 7,700, so we can plug that guy in right here. We are going to do any owner contributions. I'm looking to see if there were any. I don't see any. Let's see if there's any information up here. Assume Sergeant contributed 15,000 during June. There it is. So we're going to do owner contribution, 15,000. But let's pretend. See if we can look over here and see view the income statement. Let's pretend like we don't have that. Oh no, what do? Well, what we're going to do is we're going to calculate it. We don't have to do the income statement, but we're going to calculate it. So I'm going to do revenues. Where are our revenues? Service revenue 13,000. Okay, good. Now let's do expenses. Rent expense 600. Salaries expense 2,200. Okay, that's all I see. I don't see any other expenses. So what I'm going to do here is I'm going to take my revenues and I'm going to subtract the total expenses. So my net income should be 10,200. Let's double check. 10,200. So that's how you can calculate it if you're not given the income statement, or for whatever reason you were not doing the income statement first as part of the assignment or problem. So let's go ahead and subtotal this. We have 32,900. Do we have any withdrawals? We sure do. 5,500. We show that as a reduction or as a negative. And then we just got to do the math again. So subtract out 5,500, 27,400. It's a pretty healthy jump from initial capital there, but the owner did contribute $15,000. So that is a chunk of change there. Okay, the statement of owner's equity reports changes in capital for a business entity during a period of time, because we do the whole month. Doing the whole month. All right, then our last question. Getting that stretch. We're doing the balance sheet. Top training, balance sheet. This is going to be as of or on June 30th, 2025. Let's come over here and we're going to view the account balances. And believe it or not, we can just use these account balances and we can still calculate the owner's equity, even if we didn't have the owner's equity statement just completed. So let's have a look at this and I'll show you how to do that. At some point, I'm going to show you how to do the balance sheet correct. You're supposed to do the balance sheet on the asset side and liability side in order of liquidity, which means how soon is this likely to be turned into cash, or how soon is it that you'll have to pay for this? So in the asset side, cash is the most liquid. So I'm going to just start with cash. That's just me. You can actually just go down here and that's fine. But I always start with cash. At least I try to, unless I'm in a hurry. But cash is the most liquid. And then typically we're going to do accounts receivable. And then you can kind of go from there until you get to inventory, which is the most illiquid asset that we have. But I'm just going to go down in order now. Equipment. And equipment has 22,500. Let's do supplies for 1,300. Supplies 1,300. Mine's being kind of weird if you're noticing my columns getting bigger whenever I go into them. So I got equipment, supplies, cash, then there's accounts receivable, and that looks like the last asset. Normally, like I said, I'd go cash, accounts receivable, supplies, and equipment based on this information. That's how I would normally put these together. It looks like this column or this row is unnecessary for the assets. Let's go ahead and add those guys up. Got 1,900 plus 22,500, so 1,300 plus 8,000, and we are sitting at $33,700 in our total assets. Now on the liability side, remember we're not going to do anything that we haven't already used. So, but anything payable or unearned. So we found notes payable already. And again, notes payable, I'm going to put this down here. There's a part of me that kind of cringes when I don't do it in the right order in my brain. But notes payable is going to be paid off in a longer period of time than accounts payable, which is our other liability. So accounts payable, we are at 3,000, and then our notes payable is 6,900. And I don't see any other liabilities here. Okay, so let's we're not going to total these up. Normally I would, but Pearson just says just give me the total for liabilities and owner's equity. So we're going to put that down there, and then we're going to select here, and this is going to be Stanford Capital. But now we got to calculate Stanford Capital. We're going to do it the same way we showed you how to do it before, except now we got to go through the whole process here. All right. So revenues were 11,100. Expenses were 750 and 2,500. So now our net income is 7,850. Now let's go ahead and come over here and we're going to do the statement of owner's equity. So we start off with 2,950. We actually don't know if any amount was contributed, but our net income is going to be that $7,850. And then we're going to have withdrawals of $1,000. So our ending balance is going to be $9,800, but there could have been owner contributions that we're just unaware of. So let's go ahead and just look at the statement of owner's equity and see if there was anything. See, we didn't know about this 14,000. There was nothing there that gave us that information. So let's add that 14,000 to our Excel spreadsheet. So $23,800 is our capital. $23,800 plus $6,900 is $30,700, and we balance. Oops, I labeled something wrong. Oh, I guess we do want to do total expense, total liabilities. Sometimes it doesn't do that. That's why I thought it did. 6, 7, 8. So 9,900. There you go. The balance sheet reports the entities liabilities on a specific date. All right. Now, Alicia, anyway, the company had net income for 51,200. In addition, the balance sheet reports the following balances. Calculate return on assets for this company right here. So what to do here for this one is take our our net income, and where is that? There it is. And then divide that by our average total assets. Okay. So they're playing us a little bit here. First of all, I'm not seeing net income unless it says it up here. Here it is, 51,000. Okay. So we need to go through here and identify all of our assets. And I'm going to use Excel again, just I think it's clearer to be able to see what we're doing. All right, so we have notes payable. That's a liability. We're not doing that. Cash is an asset. Office furniture is an asset. Oops. Building is an asset. Accounts payable is a liability. Equity is equity. Accounts receivable is an asset. Equipment's an asset. Supplies are an asset. So these are our assets. So we need the total assets. One way to do that is to add all of these up for the beginning of the year and the ending of the year. And then what we're going to do is add these together and divide by 2. Okay, so I got 320,000. So let's take our net income of 51,200 and our average total assets of 320,000. So now we need to just take those numbers and find out what our return on assets are. So take 51,200, take this divided by our average total assets, and we got to see the decimals there. So we got 16% is what I got. Does it say to round anything? It doesn't. So let's see if it's okay with what we did there. Maybe we need to go to a decimal point. Nope, we're good. Okay. All right, and that's your chapter 1 homework. If you have any questions, you guys know how to reach out to me. If it's Saturday or Sunday, I may not be responding, so you'll want to make sure you reach out to me sooner than that. But anyway, hope you have a good one. We'll see you guys in the next chapter.